On your first day of trading, I'm sure you heard the statement, trade the trend. The trend is your friend. And then on your second day of trading, you learn how to read these trends through market structure and supply and demand. So when your framework as a trader is looking at a bullish market at higher highs and higher lows, and then a bearish market as lower highs and lower lows, you end up looking at the market from a very specific lens. And although I'm in agreement that trading with the trend is always going to be better, however, there is one key issue here, is that when price starts to do the new trend, it usually happens so quickly that you can struggle to get in if you already missed the ship. And therefore, as a trader, if you really want to ride that wave, you actually have to get on the ship at the right point, at the harbor, because when that ship is already out at sea, you won't be able to get in because price is already gone. The ship has already set sail. And therefore, what that means as a trader is you need to know where the ship is going to sail from. You need to know where are those key market structure points, those key demand and supply areas. And that's fine if you know how to read it. But the problem is, if you don't know how to read it, or you missed the opportunity, or it didn't meet your requirements, that means you could potentially miss out on the whole trend. And usually what does that mean for a trader? Frustration to either revenge trade your way in, ending up with a huge stop loss, ending up catching the market when it's already too high, and then it reverses on you, and you end up having a string of losses for no reason. But what if I told you those days where the market is rocketing, that you usually sit out and say, no, this is not for me because there's no entry for me? What if I told you those are the best days? Those are the days where you can find great setups and they fly to your take profit levels effortlessly. These are the days you need to be trading, and this video I'm going to show you how to trade those days that are maximum volatility, maximum in one direction, and most traders are missing out on. What usually people would consider a missed trading day or a no trade day, I'm going to show you how you can get in reliably, how you can maximize your profits and risk to reward. And I'm going to show you that with not just a cherry-picked example that happened once. I'm showing you something that is repeatable that we've shown in previous videos, and more importantly, an example from today's price action. So before we understand how to trade the most volatile moments in the market, we first have to understand where the trend is going to be and where the origination of the trend is going to be. So for that, we need to understand first of all a very basic principle, which is higher highs, higher lows, and higher highs. Now, this area might confuse someone, so let's just break it down very quickly, which is that this area was a previous ceiling in price. So this area, although it had certain higher highs and higher lows within it, it was not relevant from the previous ranges. So you actually have to understand trading ranges that are going to be bound by these structure points. So for example, this dotted line is your previous high in the market, and this was the previous low in the market. So this low led to this high, this became a new range. And then when this area failed to break the low of the range, we moved the range to here. And when this area was broken by this new higher high, we now have a new high in the range. So that's how you establish trading ranges. And anything internal you don't consider as new main pushes, because over here, this was the previous ceiling in price. And this previous ceiling in price, these areas did not break higher. They were just making lows. And then they didn't go and make a new low down here. They respected the previous floor in price. And therefore, this was just internal price action. So the moment you break the external range, the external high and the external low, when that is broken, and that's when you go on and readjust it. So when this area was broken, we had a break of structure happening and a new high being formed. That's when we move it and say, now our new external range is this higher high, and that was created by this higher low. Now, because we know that the previous area over here, the previous ceiling in price that was broken, we had a bullish break of structure from here. That bullish break of structure that happened, we also have a point of interest from there. And that point of interest of demand is going to be the extreme, the area that led to the high, the origination point, the lowest point in our range. That is one demand area. And if price breaks lower, we ended up breaking this range and will be bearish. And then the second point in the market is this area over here. Now, this area over here didn't begin the move. However, it was the area that this previous ceiling in price, it was broken by these buyers. These buyers had the momentum to decide the new market structure that was going to continue bullish. And because this area was deciding who's in control, that's why we call this a decisional point of interest. So when we look back at this new push in the market, this new higher low to higher high in the market, we have the extreme, the origination point, and we have a decisional, the one that actually broke the structure. And we've made many videos on this channel about refining points of interest, how to determine a quality point of interest, how to find the exact requirements of an A+ point of interest, for example, a build up, depth of retracement, time in consolidation. All of these things will really qualify the zone. But for now, we just need to know these two criteria. So once price has made that higher high in the market, naturally price will have a bit of a retracement, and it might retrace to the decisional or it might retrace to the extreme. So one scenario is price comes to this area of decisional, and from this decisional, you might just go on and make a new high high. And therefore, if that becomes the opportunity, you should look for buys in this area. You might have a moment where price reacts higher like this, gives a bit of a bullish reaction, and then you see some of the trend line liquidity here, it grabbed it, and that became the fuel to come lower. And then price comes to the extreme and then goes on to make a higher high. So basically this trendline liquidity became the inducement to fuel the move lower, break past this demand area where buyers had control previously to come to the extreme. And this is another opportunity where you can look to buy. What is the purpose? Because you want to actually make the new higher high in the market. So we can see both of these areas, the decisional had a bullish reaction. Let's say one of them was just fueling the move lower. The other one actually made the high. So both decisional had a reaction point, and the extreme in roadmap number 2, the blue roadmap, it came to the extreme to come higher and maybe grab some of the liquidity on this level. Now in either scenario, what will you usually do? You will usually wait for the decisional, wait for confirmation, reaction, liquidity, lower time frame confirmation, time of day. You'll wait for your mechanical reasons to get in, whatever your strategy may be, and then you'll look to buy to make a new higher high. And why? Because the market was making higher high, higher low, higher high, higher low, higher high. So you're just trading that simple bullish market trend. And where are those zones you look for buys? You look in the point of interest. You look in this area, or you look in this area if you want roadmap number 1 in green or roadmap number 2 in blue. Where do you find your buys? In the discounted areas, your points of interest, your areas of support, your areas of trend line, your fib levels, whatever your strategy is, you have your zones to get in. What usually happens? Price comes down into the zone and then leaves the zone. So technically when you're trading that V formation, whether it's a double bottom, triple bottom support, whatever strategy you have, is technically a short-term reversal. Its price is technically going lower at some point and then starts to go higher. So you're actually trading a reversal in some sense on a point of interest. And then if you are to zoom in and look at this portion over here, or you're looking at the green in this portion over here, you would say when price has already done that reversal from these points of interest, those V's that you can see, when price has already done the V, the reversal, then it's already too late, because then it just goes up. In these days, in these moments, don't just sit out and don't just say, it's already left, I need to now wait for the next point of interest, because you might wait days or weeks or months, depending on the time frame you're looking at. And more importantly, you will still miss high quality setups, meaning to say these points of interest, these supply and demand zones are not exclusively good opportunities. Of course, these are going to have great opportunities in these zones. These are where my A+ setups are going to be. However, there are still A+ setups on an intraday level as long as you understand the continuation model. And by the way, if you do want to join into our inner circle where we break down all of our trade models from continuation to reversal to prime setups on an intraday or prime setups on a higher time frame, from the A+ setup to the A to the B+ setup, the full understanding of the markets, and more importantly, daily live streaming every single day, multiple times a day, one-on-one coaching, group coaching, community, and everyone working together towards the goal, which is $1 million in funding. Go ahead and check out the links in the description. And even if that is not something that interests you, don't worry, because I've still got something amazing to share with you, and that is my personal risk management OS, a AI-powered, data-driven tracking sheet that you can actually externalize all of your psychology, all of your risk management decision making. Don't think about that every single day. Leave it to a journal. And my risk management OS is exactly that, because in the last 18 months that I've been using it, it's actually helped me do my public signals, where I've been able to display a public track record of live call outs where I was able to document over 55% gain in profits. So if you want to grab that, it's going to be free for life. I'm never going to charge you as long as you click the link in the description and grab it today. And with that out of the way, let's get right into the continuation model. So now we know which areas we're going to be focusing. We're going to be focusing in zones where price is already moving in a direction after it's already left the reversal zones. It's already left those points of interest. How do we end up trading these opportunities where a lot of traders will sit out and say price is already left? Well, the answer in that lies in understanding the daily cycle. If you don't understand the daily cycles, you don't understand daily cycle variations, you're really going to struggle in the markets. And I would say it's a priority to learn that. And as you know, every single day starts with an Asia range. An Asia range start, an Asia range end, an Asia range high, an Asia range low. Let's say you have an Asia range like this, where price during your Asia open was over here, and this was the low of Asia range in the end, and price at the end of Asia ended here, and this became the high of Asia. We actually have some information in here that we should not ignore. And later on in the day, you'll have your Frankfurt open, your London open, your New York open, and your London close. And within there also, you'll have your key trading windows that I've done in gray boxes. So this is how you need to actually look at the day, because you don't just look at the day and see what did price do. You have to understand and segment the day, hence daily cycles, by understanding the delivery of price and how it interlocks with time. It's what does price do at specific times and what liquidity was taken, what manipulations happened. This will help you understand the roadmap of the day, whether it's a continuation day, a reversal day, a Asia high, Asia low day. There are many variations of daily cycles. There's many ways and they're roadmaps. They are repeatable and reliable and predictable, and they follow the same blueprint. What happened at a specific time, with what confirmation and with what liquidity. If you connect this trifecta that I speak about in every video, you'll start to understand that the only way to trade is by understanding the roadmaps of price, the daily cycle delivery that happens. Because as a trader, all your job is to understand which roadmap is it today, which daily cycle delivery is it today, and can I find confirmation confirmations to execute on the daily cycle. And that's why we have trade models with lower time frame models and daily cycle variations. When you connect all of these things together, that's the only way you're going to know what is a continuation versus a reversal day. Where are the traps? Where is the liquidity? Where is the manipulations? If you don't have the answers to these questions, you haven't fully understood the markets just yet, because you'll end up just following the market from a pattern perspective or a correlation perspective. It's just when A happens, B tends to happen. Not because, it just tends to, like a support level, like a trend line, like a head and shoulder pattern. These are all correlations, not true drivers of price. So when I do see an Asia range like this, there's a few things I notice where price has left a double top. It's left a level of resistance. So what are certain people going to do? They're going to be selling on this area and their stop losses will be above. So I know liquidity is above Asia range. Same for the Asia low. Around this area, there's going to be liquidity because Asia high and Asia low is usually a liquidity point. And then at time, Asia midline as well will also be a pivot point that we need to be aware of. So when I pair all these things together, where I know there's liquidity at the high, liquidity at the low, I need to see which one is going to be raided. And then I also need to be aware that price is showing me an ascending trend line. So it's inviting buyers for the open of the market, for open of Frankfurt or London. It's inviting them to say, hey guys, look to buy because we found a bullish channel. We found a bullish trend, and it's inviting in those traders. What does it mean? Liquidity around this trend line also. So now that I've drawn out these liquidity pools in the dotted line in purple and the Asia midline and our time markers and our key windows, now we have a framework to watch the day with. So now let's say the market opens and it's approaching Frankfurt. And as Frankfurt open is approaching, we know that Frankfurt open is usually a trap moment. So let's say price shoots up over here. Now price has shot up over here and then we end up consolidating around here. Now, what information have I got from this? Well, we have to actually understand intentions. So for example, we know that equal highs, this 1 touch, 2 touch, 3 touch, who loves that? Smart money traders. Smart money traders love equal highs, and then they love a smart money run of liquidity, an SMC concept. So what is going to be happening in this area is, if you understand smart money traps and the framework, you will know this is the blueprint of a smart money trap zone. So I'm going to mark it out. And what does that mean? It's not going to be respected. It's going to be a magnet for price. Price is going to be attracted to this area to invite in smart money traders liquidity, and then it's going to take them out. So when I see something like this, I know price is going to be attracted towards this area, maybe give false hope, and it's going to break through. So I already have a target. And if I know price has already hit my demand area, I've already had that V moment, that reversal moment, and now we're in that portion where price is flying. And then I see trap, which is a magnet for price. So if I know price is attracted to that smart money zone, it's going to break through at some point because price has already gone in that direction. We're already having that bullish moment, that bullish day. We just need to find how to get in. Then I need to understand that I've also printed a liquidity pool right here. So now I've got two relevant ones and I'm going to differentiate them like this and like this. So now we can see we've got this trend line liquidity where we had all of these touches, 1 touch, 2 touch, 3 touch, 4 touch, etc. Trend line liquidity, and then 1 touch, 2 touch, 3 touch, 4 touch. So we've got trend line and we've got support. So when we find these liquidity pools and a magnet to go above on a trending day and it's around our Asia midline, we're starting to build the building blocks as the time window approaches of London of a continuation setup. Then I just need to know a lower time frame modeling, and I need to wait for the inducement of the day, the trifecta: inducement, lower time frame confirmation, time of day. If I can find all of these things together, in this context, I found a continuation setup. What can that look like? Is price goes in, manipulates over here, manipulates this support level, manipulates this trend line, inducement low. What is happening over here? People are going to be loading up on sells because they don't understand the market. They're going to see run of liquidity. They're going to see price holding this level, break of structure. They're going to be selling in this area. So where is all the liquidity now? We grab the liquidity of the support and all the new liquidity is on this level or is on this level because of the break of structure, and everyone is going to look for sells. So what is the market going to do? As you know, the opposite, especially in a bullish day, especially if you've already left a demand area and you're having bullish momentum. Look for buys in a bullish scenario and don't look for these always reversals. Don't always try and catch the top or catch the bottom. Don't always look for reversals. Continuation with the trend, because it's your friend, is the better way to be trading in this context. So when I've seen that inducement, I just wait for a lower time frame modeling in my key window, the gray box. I allow price to come to the smart money zone. I allow smart money traders to get a bit excited. They're now seeing bearish, 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 and then we rock it through, and we rock it through for the rest of the day. So smart money traders got in this area. They had a bit of hope, a bit of profit, and then destroyed out. So what happened in the end? Price just went up and up and up all day long, and we got an opportunity to get in. How were we able to be getting in? Is because we knew this was a trap and this was going to be a smart money zone and a magnet. We knew that this was the inducement of the day. The time window and lower time frame supported us, and we ended up getting a rocket of a trade, a continuation model with the trend and understanding traps, manipulations, liquidity. Now that we've got the theory out of the way, let's show you a price action example from today. So let's take a look at this price action from today. What are we identifying first of all? First of all, we notice that this minor inducement over here broke past this, gave a break of structure and ended up making a higher high. We have now found a main push. As we were mentioning at the beginning of the video, we now have an external range. This means that's the high of the range and this means that's the low of the range. We have now found a main push and it is bullish. What do we see after that? We see internal structure. What do we see? That price is doing a pullback, fails to make a higher high, breaks this level, makes a lower low. So now we've got a bearish internal structure and we have lower highs and lower lows, lower highs and fails to make a low, fails to make a high, makes a sweep of liquidity and then boom, bullish break of structure, internal higher high, breaking past this previous lower high over here and we've got a bullish break of structure. So when we label all these things out, we're just following simple market trends and we can see multiple levels of break of structure, especially over here where this internal lower high made a internal lower low, broke past this level. So we had a bearish push down, which was just to grab liquidity, come to this weak demand and then reverse, break structure, break structure, break structure and make a higher high. What happened after the higher high? We didn't go on to make a lower low and continue that bearish trend. We didn't break the external range and make a lower low. What did we do? We actually made a higher low. We supported the area that caused this bullish push. We came back and we respected it. So what are we seeing? We're seeing a bullish push up, main push, retracement to this area and now bullish signs again. So what are we going to target? New bullish momentum because the market is bullish and breaking that external range to continue the bullish trend. So when we have that framework, we know what direction we're going. We're knowing where the points of interest are. Everything is crystal clear because we have demand area that led to a higher high made by an inducement, prices respecting. What is next? Obviously, we're going to break past this level and go on to break this level. So we're looking for bullish movements and prices already come to the demand area. We've already had that V. We've already had the reversal. So what do we look after reversal? Continuation of trend towards target 1 and target 2. Very, very simple market structure. Very, very simple. Every single one of you should be able to do this if you just know the principles of the markets. Now, when we come to, let's say, an M5, we take a closer look. Now that we've understood a dealing range, which is we've had a bullish break of structure, and we know that this inducement over here of this liquidity, this support level, these lows, whatever you want to call it, this inducement led to a bullish break of structure. So we do it in green. We make it nice and clear. We know we are now bullish. And where is it bullish from? It's from this inducement. And what is the next target? It's a replication of that. We are looking for a new bullish move to target the external range. We're looking for that. Clear as day because price has already come to the extreme that we mentioned at the beginning. So when we know that's the objective of price, we now need to read the details. We know direction, we know trend, we know zones. Now the details come in. So first thing I notice is that we have this level of sweep, this inducement, and then we have the same thing over here, another inducement. So when I see a market profile like this, where we have a buildup of liquidity and an inducement low, and then a buildup of liquidity and an inducement high, then I know the market is approaching indecision because these buyers are not sustaining control because this inducement that led to this push went on to fail. It didn't go higher. It actually failed and went lower. So I know when this area that is just a minor inducement, it's not expected to hold indefinitely. And why is that? Because it served its purpose. This inducement allowed price to come higher. Then new fuel in the market, this inducement allowed price to go lower. And what are we seeing, by the way? We're seeing very clear-cut control where this inducement has now had a mitigation is very, very clear. And this build-up and this inducement over here broke through this previous inducement zone. So what does that tell me? Sellers are in control. So when I see the sellers are in control and then they arrive to this demand area, the extreme, then I know that price can start to transition. And when we see that price is making a low, lower high, lower low, arrives to this demand, the reversal point, and then what does it do? It makes a higher low that makes a higher high, and we have found a trend. Wonderful. So we've found a reversal point, which is demand. We found the bullish price action after it, and we know that we are continuing this bullish trend. We are looking in this direction. So price has already left the demand area. So there's no point now wishing we got in over here, and there's no point now just waiting for price to fly and saying, okay, oh well, better luck next time. No, we can actually find opportunities in rocket days because price is ready to rocket. We just need to understand how we're going to get in. So what do? We go on our M1 time frame. We understand direction. I turn on my custom indicator that I coded with the same markers that I mentioned earlier in the video. There's going to be the same things we mentioned. Beginning of Asia, end of Asia, Asia high, Asia low, the midline, and then the markers of Frankfurt Open, London Open, etc. So we're going to use all of this information to our advantage. So now just following the dots, as you already know, red is bearish. We saw this inducement go bearish. We arrived to this demand area, and then we had the reversal. We have the indecision because this didn't make a higher high or higher low. This one didn't make a lower high or lower low, but then this area breaks it. So we have a trend form from this point because we have a bullish break of structure. breaking this area, and then failing to make a lower low, actually making higher low. And now we are actually establishing what's happened here. So now we know structure, what's going on. We read details once again. So here we can see price arrived to a demand area, gave a bullish reaction, fails to make a lower low, and actually does a minor inducement that leads to this bullish break of structure. Lower low, higher high. We've had a reversal point. So price is actually respecting demand. I can actually start to read and understand control from this, that we are seeing price go to a demand, price come to the same demand area, doing a minor inducement, bullish switch. And then what do we get? Build up of liquidity, inducement. So we can see it's actually repeating and it's showing us who's in control. It's not random. We can see inducement number one, control, because it's actually crazy sometimes that the level of detail there is in the market. Build up, inducement, bullish break of structure, breaking this level. Same here, build up of liquidity, inducement, bullish push out. So when we are seeing inducements of control, we can now start to understand the trend, but we can also start to see that this is not a fake move, it's a real move because inducements are controlling it. But then we also need to be aware of the traps. And this is now just showing me liquidity pool. Liquidity pool that we were mentioning earlier on for the continuation model. And we can see that there's going to be stop losses on this trend line. Now, when price starts to break out towards Frankfurt Open, what do we see? Price printing, and then it does exactly what we mentioned in the diagram of the continuation model. We have a very clear support level of liquidity, and we have a sweep high that smart money traders are going to be loving. Why? Because smart money traders love these equal highs, and they trade those order blocks, those smart money candles, those sweeps, whatever raids they call them. This is going to be a smart money trap because we can also sense it from time. It's a trap time. So now we've got the liquidity pools marked out, and now we are just waiting for a Asia midline scenario for London Open, a continuation model. So we play it. What's happening here? As we mentioned earlier in the video, smart money traders are going to be putting entries in this area. They're going to be putting entries in this area. They're going to be putting entries in this area. If it comes back, stop losses everywhere. Why? Because they've seen Asia high raid, smart money run of liquidity, and bearish break of structure, breaking this level. So what are they waiting for? Sells and sells and sells. What do we know from structure, from inducements, everything we read? We know that that's not the case because we can sense that the buyers are in control. We see that over here. We're seeing that this is a trap. So we know that here price is simply going to be magnetized towards that trap after it's grabbed the liquidity of these lows. So this is simply forming an inducement, and therefore I know who's really in control in the market because I'm identifying inducements and I'm not seeing it as breaks of structure. I'm grabbing liquidity of zones. Now I can't confirm it just yet, so I need to wait for the confirmation, which is going to be waiting for lower time frame and time, which is why we don't just get in on zones. This is key. You wait for an inducement, you sense it could be an inducement, and then you wait for confirmation. And how do you wait for inducements? You wait for the low in the market that has grabbed liquidity around your time window, exactly London Open, on the minute ideally. And then you see what's going on over here. And you see, okay, we've got all of this trend line targets as a liquidity pool and a smart money trap above. This is telling me magnets everywhere, prices attracted towards this area because all we see is a bearish trend, smart money traders, everybody is looking to sell. What is the real market doing? What is the real intention over here? The real intention is we grab the liquidity around this trend line, we grab the liquidity around the support level, and what are we really seeing? Price is supporting this demand area right here, and this demand area is relevant. Why? Because internally it led to this bullish push, and now we're just looking for a replication like that from this inducement. As long as we confirm it, we have now got the trifecta because we have time window, we're sensing an inducement, and we just need the confirmation. So when I see price does a small sweep of this liquidity over here, a minor inducement approaching London Open in my demand area that also had a minor inducement within it. Now I'm getting all the building blocks. I've got the time window, I've got the inducement, I just need confirmation. So I go candle by candle, waits for my time window to open, and I see perfect. On the time window, on the minute, what do we see? Bullish break of structures. Why is this a bullish break of structure? Because this lower high pushed down to make a lower low and then switched to make a higher high. And what happened? Coincidentally, London Open on the minute. We've got time, we've got lower time frame confirmation, we've got inducement, and we're finding the key building blocks textbook for a continuation setup. It doesn't get better than this. I've shown it on many videos. Here is an example from today, not cherry picked, and don't just take my word for it. See all the traders in our inner circle who are trading these day in and day out. Take my public signals, take my track record. You don't need any more proof. This is the essence and reality of the market. Don't be blind, don't be ignorant. Learn the rules, learn the language of price, and read it every day and wait for your quality setups. So what do? When we've got all of the confirmations we need, we simply identify a demand area of inducement. We load up our buy entry and we say, here is the refined IFC in this area, and we are looking to trade out. And what do we see? Price goes in and immediately reverses. What does it do? Immediate reaction. And we know where are we going? We're going to trap these smart money traders. We're going to grab their liquidity. This magnet is in full effect. And slowly but surely, smart money traders are thinking, oh, oh, one more chance. We just grabbed a bit more liquidity. They're loading up once again. What are we seeing? More and more magnets. It's not a seller's day, it's a buyer's day. And slowly but surely, key window rocket, it should go on and on. Now, why should it go on and on? Because we've understood trend from the correct perspective. We've come to a demand area that led to a higher high. Remember what we mentioned earlier, this demand area led to a higher high, and now we're just looking for that continuation. And we're looking for that continuation to come towards the external range. And when you find a rocket day, you can actually have that in a single day. When you have that singular bullish push, as we mentioned throughout the video, when you understand demand areas, control from inducements, internal price action, Asia range daily cycle, and a continuation model. And then once you are locked and loaded, you've got in from the continuation model, what do? Let price fly. Let price do the heavy lifting, and you don't have to do anything further. A single day, a New York window, people are going to be jumping into sells. No, we know it's a continuation day. So in a single day, it's a possible of a 1 to 30 risk to reward, effortless day. And then when you zoom out and you ask a newbie trader what happened today, they'll say, oh, that's very simple. They'll simply say, this is very easy price action. It's higher high, higher low, higher high. Yes. Simple higher highs and higher lows, but the details for us to be able to capture that is understanding daily cycle, inducements, the trifecta, everything we speak about in this channel for an effortless trade, a rocket trade. And on a day like this, there's no other way to get in. Once it's left, there's no way back. The ship has sailed. There's no retracement. There's no consolidation. There's no reversal. It's just bullish in one direction. And even if you don't get in at the demand area, there's another opportunity on the continuation model. The wonders of the markets, we've made many case studies on it. You've seen the track records. There's nothing left to say. Just please watch more videos on this channel, understand the essence of the market. My job here on this channel is to help you understand the markets better for free by showing you all the trade models, by showing you all of the essences that no one speaks about, because this is the reality. I've been trading for almost a decade now, made millions of dollars, and the key thing is trade models, inducements, confirmation, time, and most importantly, a restricted trader is a profitable trader.